Have you ever wondered if there's an easy way to grow your money without picking individual stocks? Well, ETFs might just be your new best friend in investing. Stick around and I'll break it all down for you in simple terms. ETFs, or exchange-traded funds, are like a basket of investments. They hold multiple stocks, bonds, or other assets. When you buy one ETF, you're essentially buying a small piece of all the investments in that basket. For example, imagine a fruit basket. Instead of buying just apples or oranges, you get a mix of fruits. An ETF works the same way. It gives you instant diversification without needing to buy each stock individually. Plus, you can trade ETFs on the stock market, just like you would with regular stocks. Now, why choose ETFs over individual stocks? The answer is simplicity and reduced risk. Picking individual stocks can be tricky. You might buy a stock that performs poorly and your entire investment takes a hit. But with an ETF, your money is spread across many investments. If one stock in the ETF doesn't do well, others in the basket might perform better, balancing out the risk. For example, instead of buying shares of one tech company, you could buy a tech-focused ETF. That way, you're investing in a variety of companies like Apple, Microsoft, and Google all at once. ETFs come in many flavors depending on your goals. These track a group of stocks, like the S&P 500. They're great for long-term growth and often serve as the core of a beginner's portfolio. Stock ETFs are an excellent choice if you're looking to invest in the overall market or specific sectors like tech or healthcare. These focus on bonds, which are loans made to companies or governments. Bond ETFs are typically safer than stock ETFs and are great for balancing risk in your portfolio. For example, if the stock market dips, bond ETFs may remain stable. Want to invest in specific industries like technology, energy, or real estate? Sector ETFs let you do just that. They're a good option if you believe a particular sector will perform well, but don't want to pick individual companies within that sector. These provide exposure to markets outside your home country. For instance, if you want to invest in emerging markets like China or India, international ETFs can help you diversify globally. These focus on specific trends or themes, such as clean energy, artificial intelligence, or cybersecurity. They're great for aligning your investments with your interests or values. These invest in short-term, low-risk assets like treasury bills. They're ideal if you want a safe place to park your cash and earn modest returns. By understanding these types, you can choose ETFs that align with your financial goals, risk tolerance, and interests. Creating a solid ETF portfolio is simpler than you think. Here's how. Start with a core ETF. Choose a broad market ETF, like one tracking the S&P 500, to form the foundation of your portfolio. These ETFs provide instant diversification and exposure to the overall market, making them a great starting point for any investor. Diversify by adding sector or international ETFs. Once you have a core ETF, consider adding ETFs that focus on specific sectors or international markets. For example, if you're optimistic about the tech industry, you can include a tech-focused ETF. Similarly, adding an international ETF can give you exposure to global opportunities and reduce reliance on a single economy. Balance risk with bond ETFs. To reduce risk, especially during market downturns, include bond ETFs in your portfolio. Bonds tend to be more stable than stocks, providing a cushion against market volatility. Consider your investment goals. If you're saving for retirement, you might focus more on growth-oriented ETFs. If you're looking for income, dividend-focused ETFs or bond ETFs might be a better fit. Rebalance regularly. Over time, the value of your ETFs will change, which can shift your portfolio's balance. For example, if your tech ETF grows significantly, it might take up more of your portfolio than you intended. Rebalancing involves adjusting your investments periodically to maintain your desired allocation. For instance, a beginner's portfolio might look like this: 60% in a broad market ETF, 20% in a tech ETF, and 20% in a bond ETF. Finally, let's talk fees. ETFs charge something called an expense ratio, which is a small annual fee for managing the fund. It's usually expressed as a percentage of your investment. For example, if you invest $1,000 in an ETF with a 0.1% expense ratio, you'll pay just $1 per year in fees. Compare this to mutual funds, which often have much higher fees. Low fees are one of the reasons ETFs are so popular. They leave more money in your pocket over time. Don't forget to like this video and subscribe for more investing tips. See you in the next one.